Started here. My name is Lynn Voss with Golden Care. I am joined today by Vern Singer. He is a regional director with Greenhaven Marketing. Now, first, a little history. Greenhaven Marketing and Golden Care, we've worked closely together for decades. Both of our offices have expertise in various insurance fields, and together uh, we have experience, industry insight, sales strategies, best in class customer service. And we're bringing this to a broader array of agents with our collaboration. In 2021, we actually created that collaboration, the Strategic Alliance, actually joining together in one office building. And now we are both thriving under the Integrity family of companies. Vern himself, he's got over 35 years of experience in the long-term care, health, life insurance. He's got a ton of experience. He started with Greenhaven Marketing back in 1992, and he is currently a regional director. So he spent last year putting together some continuing education course material surrounding extended care and the various options and solutions available that can help fill the need. And we're actually thrilled to have him join us today because he's going to share with us a little bit about what he learned. So I will go ahead and turn it over to you, Vern. Make sure you unmute your mic. All right, bear with us here.
There we go. I finally found the emblem.
Okay, good deal. We are ready whenever you are.
All right. Well, thank you for the introduction, and we'll get on to this right away. Now, when we talk about why do we need to look at long-term care insurance, let's look at some of the hard statistics. 75% of people turning 65 will develop a severe long-term care need. So 3 out of 4 people. That's very significant. Hey, the only thing that's got greater odds is that we are going to die. So why not try insuring this need for people? We look at 48% of people turning 65 will need some type of paid long-term care services. The average stay for women is 3.7 years. It's only 2.2 years for men. That's, again, the average. Now, we look at about 42 million people in the US are providing care today for a person that's age 50 or older. 57% of caregivers are caring for a parent or a parent-in-law. A lot of times it's that daughter-in-law that gets stuck with it. I think of one example of a client that I had, and I got because in her case, there were 6 kids. They all lived in the same small town, but when dad died, the one daughter said she would take care of mom. The other 6 kids held her to that. Mom was an invalid, was in a hospital bed, 24 hours a day. It was so bad that even if they wanted to go out to have dinner and stuff, the other kids wouldn't come over to watch mom. They ended up putting her in a nursing home for 2 weeks so that they could go on a vacation to try to regain their sanity. So, caring for somebody can be very stressful. 40% of caregivers are giving care for someone age 50 to 74. Now, we look at what's the difference between long-term care and short-term care. Well, I use the deal with long-term care based on the partnership plans. All states require partnership plans to have at least currently a minimum of 2 years of care. So short-term care is anything that provides coverage less than 2 years in duration. Now, let's look at some of the common activities of daily living that we look at when we were talking about long-term care. The 6 main ones are eating, toileting, transferring, bathing, dressing, continency. But we also look at, or the underwriters also look at things like, are they able to do their own shopping, their own housework, laundry? Who's taking care of the bills? Using the telephone, being able to walk outside, climbing stairs, all of those things are things that the underwriter will look at to help evaluate a client. And one of the things when we talk about underwriting, when I started in this, 35 plus years ago, we had yes, no applications with 10 questions that if they answered no to, they were issued a policy. Now we have about 50% of clients are being declined, even when we're talking about clients in like 50 to 55 age group. So we want to look at, and that's on traditional long-term care. And that's one of the reasons why some of these other plans are taking off and are something that we definitely have to look at. Now, here's the traditional long-term care policy. I just used one company here to give us an example. They have either a daily or monthly benefit. We can look at policy lengths anywhere from 2 years, 3 years, 5 years to an unlimited benefit. Again, when I started in this 35 years ago, a lot of the policies written had an unlimited benefit. Now, a lot of policies are 2 or 3 year benefit periods. Partnership qualified. When we look at this, and the reason that this is important is, really somebody that has no assets doesn't need to worry about long-term care because Medicaid's going to take care of them, right? Millionaires might not have to look at it because they have the assets to pay for it. But on the other hand, I have millionaire clients that say, why would I pay $1 for something when I can insure it for 10 cents? So the partnership qualification is really important for that middle class area. And what that partnership plan does is just allows us to protect a certain amount of assets and still qualify for Medicaid spend down. Elimination period, this can be anywhere from 0 to 365 days. A 90-day elimination period is the most common. Some policies have a cash benefit, so think of it as an indemnity. Most of them currently have a limited cash benefit, like 15% or 20% of what it would pay if you went to the nursing home. They cover nursing home, they cover assisted living, they cover home health care benefits, adult daycare, stay-at-home benefits. This can be, I've had policies that have paid to have a walk-in bathtub put in the home to allow the client to stay at home versus going into the nursing home, because it's going to be cheaper to keep them at home than it is to put them in a nursing home. Bed reservation, this probably isn't all that important, but it's a benefit that's in there. It just allows you to, if you recovered or had to go to the hospital while you were in the nursing home, you can reserve your bed to come back so that they don't give it to somebody else. And respite care. Now, this is where we're looking at going to be important for the caregiver that's taking care of somebody at home. Maybe they need a break to go sit on the beach and drink a few Mai Tais and stuff for 2 weeks to recuperate. Again, that's what that is for. Hospice benefits, waiver of premium. All of these policies, once you start receiving benefits, the premium is waived. So those are some of the standard things that are built into a long-term care policy. Now, we look at why is this important? Well, if we look at the claims in 2020, they paid out over 11 billion in claims. In 21, it went up to over 12 billion. 22 over 13 billion. 23 over 14 billion. And the number of claims the number of people on claim is increasing. We've had claims now that I believe the longest claim has gone over 2 million already. So somebody younger And a lot of people don't, think it's only old people that need this. But there's 40% of people in nursing homes are under the age of 65. So think about that. There's a lot of people, can happen at whatever age. And, age isn't the important factor. It's the ability, again, going back to looking at those things of, do you need help dressing, bathing, toileting, transferring? I think of, my brother-in-law decided he was going to go out swimming, jumped in, came out of the water as a quad. Long-term care would have been a great benefit at him. I also think of my youngest client was an 18-year-old that the dad was an insurance agent, and she was competing for a spot on the Olympics, and she jumped horses like Christopher Reeves. So he said he wanted something just in case. And for about $500 a year, he had something to protect her. Now, let's take a look at, when we look at an inflation or a long-term care policy, this is kind of where I start when I'm talking to people. I'll look at a $6,000 monthly benefit, a $220,000 policy limit, which is about 3 years of coverage. And then we can take a look at, how do we handle inflation? Because if we're looking at a 50-year-old, we're not planning to use it today. But we can see how the inflation option affects the premium. And as you see here, women are going to be higher because they're the ones that are in the nursing home. And when you walk into a nursing home, what's the ratio of men to women? It's probably 20% men, 80% women. Quite common, because again, we go back, look at the statistics. Average stay is about 3.7 years for women and only about 2.2. Again, we look at age 55, same thing. As you notice, the 5% compound inflation, age doesn't have much effect on what the benefit costs. A little more with the 3%. But we'll take a look at that. Here's age 60. Again, 5% compound inflation is going to be about the same cost. But this gives us some options on how we can design these policies to better give them more benefits that may be more important to their individual situation. Now, here's partnership protection. Here's an example. Again, the age here isn't that important, but on this one, I'd be looking at somebody that was probably age 65. We have a premium for the couple of $7,700 for the plan with 3% compound inflation. But look at the same plan, but we drop it to 1%. We can go up to $9,000 monthly benefit and $3,800 for a max benefit. Now, when we talk about partnership protection, remember that's that max benefit. That's what we're able to protect. So is it more important to have the inflation benefit, or is it more important to have that max benefit be as high as possible in what we can protect? I will lean most of the time towards using a 1%, or if they're old enough, we can even drop it down to, instead of having the 1% go on forever, where it only increases for 20 years, but we can bump that benefit up to $444,000. So this is just one of the differences and stuff that we can look at that will give us some advantages of how to, position these plans. Again, I look at, if we're trying to sell it because of the partnership protection, look at getting that max benefit up as high as possible. And we're also building in some of the inflation right up front. We still have 1% compound inflation. And remember, at 3% compound inflation, it's going to take 24 years for that benefit to double. So we've got with 1%, we've got a third of that benefit up front right away. Now, when we look at, a lot of people will say, well, with long-term care insurance, if you don't use it, you're just throwing away your money. Well, that's true from one standpoint, because again, a traditional long-term care policy is like your fire insurance. It's only there if you need it. It'll give you a benefit. When we look at life insurance, we can avoid that, no use it or lose it. Most of the plans, when we look at just traditional life insurance, the one will offer from 2 to 4% of the face amount of the policy can be collected as a long-term care benefit. And, that means it could pay from 24 months to 48 months. We can get it with either a chronic illness rider or a long-term care rider. And the difference between these is that the chronic illness rider has no additional underwriting. If you look at the long-term care rider, you can qualify for the life, but not qualify for the long-term care benefits. So these are some of the differences if we're looking at just either a UL life insurance or a whole life policy. These are some of the common features that would be in just a long-term or a life product with either a chronic illness or a long-term care rider. Now, when we look, if they have a chronic illness rider, looking at that rider is very important. This is on this, and again, this is looking at one particular company's rider, their definition. It's automatically added to eligible policy at issue, and this is looking at one where they have either the chronic illness or the long-term care rider. And in this one, it's if they don't qualify or don't elect the long-term care rider, they get the chronic illness rider. It allows them an annual request for an elected portion of the base policy specific amount when the insured is chronically ill or other conditions are met. And their definition of chronically ill is an insured that has been certified by a licensed healthcare practitioner as having severe cognitive impairment or unable to perform without substantial assistance of at least 2 of the following activities of daily living: bathing, continency, dressing, eating, using the toilet, transferring, which is moving in or out of bed, chair or wheelchair. Now, that up to that point, that is basically the same definition that is used in a long-term care policy, in the traditional long-term care policies. But on this chronic illness rider, if we look at the rest of it, is being expected to need substantial supervision to protect the individual from threats for the rest of their life. That is a very restrictive one. So I've seen other policies where that, starting at number 3, it's not there. They're using the same definition on some of the chronic illness riders that basically a traditional long-term care policy uses. So this is something important to look at when you're looking at different plans to represent. Now, again, here's an example of that chronic illness rider. And with this company, the illness rider is all ages, all risk. If you want to qualify for the long-term care, you have to be age 30 to 79, and it'll only take up to a table 4 rating. The chronic illness rider is included in all policies. The long-term care requires additional underwriting. Now, with the long-term care rider, there's an upfront cost. We know what it is. With this particular company, if they do the chronic illness rider, there's no upfront charges. However, the benefit is reduced by an actuarial discount and a flat $100 fee. And how that actual actuarial discount is calculated based on the insurer's remaining life expectancy and the current Moody's corporate bond yield average. So we don't know it at the time. And if the client never uses the benefit, they won't be charged. So, again, it's better than nothing, but it has some limitations in this particular case on this one. So again, I stress looking at how that definition is if you see it in a life policy. Here we look at they have 4 different rating classes for the long-term care rider. You can select on this particular company. You can take a 1% option of the face. So the death benefit would have to be at least $150,000 for the 1%. It could be as low as $100,000 for the 2% or the 4%. Can't be more than $2 million for the 1 or 2%, and a max of $1.25 million for the 4%. So these are, again, this is one particular company's options. Again, just some more definitions. They're using very similar definitions in these. One difference with the chronic illness, it is an indemnity product. They get paid cash. No restrictions on how it's used. All they have to do is provide proof initially that they're chronically ill. The reimbursement ones, like a traditional long-term care policy, on the long-term care rider, they still have to supply, to show the receipts from the nursing home, all of those things that have to be done to get reimbursed. Again, here's using an example of a 50-year-old male, $1 million life policy. If he becomes chronically ill at age 75, his long-term care expenses are, in this example, are $16,000 per month, $129,000 per year. And that could easily happen. With the long-term care rider, he's going to need to take $192,000 in benefits to get $192,000. Now, what he has to look at in this is he paid 25 years of the rider charges of $26,000 in addition to what his long-term care benefits, or the long-term care insurance, or the life insurance, excuse me, actually cost. Now, he would have a remaining death benefit of $808,000, and he could accelerate up to $808,000. With the chronic illness rider, he only gets to, he has to take out almost $250,000 because it's only going to pay 80% about of that to get the $192,000. And again, we look at these. If he only has 2 years, this is with 5 years of life expectancy. With 2 years, he doesn't have to take quite as much. But again, the cost is what we have to look at. We're not going to know it on the chronic illness rider until when he goes on claim. Now, let's take a look at some of the life long-term care hybrids. Now, these are a combination of a life insurance with a long-term care rider built in. Again, this one works good for people that fear that a traditional long-term care investment will be wasted if they don't use it. The amount of the long-term care benefit is usually going to be a percentage of the life insurance benefit. So it might be 150% or 175% of the life insurance. And again, on some of these, the rider can be underwritten separately. Now, here is one company. This one is a true life hybrid. You get a life benefit on this example of $144,000. We are looking at the long-term care benefit of $216,000, which would give you $6,000 monthly benefit. Now, because this is a life policy, even if you collect all the benefits for long-term care, there is still a death benefit of $2,800 or $28,800. Now, if we look at this for an age 65, male is going to be $4,000, female is about $3,700. So again, these can be fairly comparable to what a traditional long-term care policy is, especially if you try to put in a return of premium on a long-term care policy to get it to do somewhat what this does. But again, you got a little extra cost up front because you have that built-in life insurance benefit. So this one is a nice one. This one gives you the option of paying it in as a single premium. You can pay it over 5 years, 10 years, or up to age 100. So you have a lot of options on how this one. Here's one where it is a universal life with a chronic illness rider in. Now, with this particular chronic illness rider, it doesn't have anything in there that says, the only thing it says is if you need help with 2 activities of daily living or have a cognitive impairment. It doesn't say that you have to be permanently disabled. So this is a very broad definition. This particular one, I used this one in the past a lot, and I use the example on this one with my sister-in-law that has MS, that was diagnosed with MS at age 50, has this policy and has that built-in chronic illness rider because she would never qualify for a traditional long-term care policy. So, but this one is you have to buy $300,000 because with this company, it pays 2% of the face amount and it pays it over 48 months. But you, again, always have a death benefit of at least $12,000 in this situation. Here's another one. Again, this one is a universal life policy with a long-term care rider. Now, on this one, you have a choice of taking where it'll pay 2% of the face or 4%. And again, to compare all of these, I tried to use a $6,000 monthly benefit so we can try to compare things. Now, again, if we're doing the $300,000 at 2%, it's going to take 4 years to pay it out. If we do 4%, it can pay it out in 2 years. But the advantage of that, it allows us to take less death benefit and still have that same monthly benefit. And again, that can cut the premiums down significantly. So this is one of the different things to look at when we're looking at different universal life policies or whole life. They come, each company does a little differently, but there's a lot of them out there that have these types of riders in there that would make sense to look at when you're offering these. Now, here's going back to that first hybrid A that I looked at. Here's a good example of the premiums. We're looking at age 55. The premium would be $53.26. They have the death benefit of $144,000. They got the long-term care benefit of $216,000. But on this one, we can also throw in a 3% simple inflation. So that monthly long-term care benefit grows, and so does the total benefit. So again, these are just some of the options that we have out there to look at. And these have built-in guaranteed interest rates. I remember with one of my clients talking to a couple that was 64 at the time. And we were looking at sitting down talking to him. He said, well, I've got about $200,000 sitting in the bank earning less than 0.5% of interest at the time. And he said, well, this makes sense. I can do, when we were looking at a single premium in that situation on a 64-year-old female, the premium was about $85,000 single premium. And he said, hey, if she dies tomorrow, I get a bump up to 144%. If I need it for the long-term care, I've got 216,000. He said, where do I sign? And unfortunately, at age 68, she developed Lou Gehrig's disease and went on claim. Here's the same thing, again, with just a female. As you can see, the premium is a little higher because of the long-term care benefit built in. And here we have a combined hybrid policy where between them, they're going to be paying about $15,000 a year. They have a death benefit of $288,000, a long-term care benefit of $432,000. And again, we can see that that benefit with the 3% compound or 3% simple inflation is going to, oh, actually, it's 3% compound inflation. Got to look at my benefit, how it's growing there. This can be a good option for people. And with this particular company, again, you have an option of paying it for 5 years, 10 years, single premium, or up to age 100. This one can work quite well in a situation where maybe you have a business owner that's 55, planning to retire at 65. He can take that out and have the company pay the premiums for the 10 years and have it paid up. I had one where they were actually a couple of years into the 10-year paying of the plan, and they sold the business, and one of the requirements was that the new owner continue to pay the premiums for the remaining 10 years. So this one can do a very nice job, very simple. And the nice thing on this one too is this is paid as a cash benefit. It is not a reimbursement policy. It's going to pay the $6,000 cash, and you spend it how you want. And that's one of the other differences with some of the life hybrid policies is a lot of them are an indemnity benefit rather than a reimbursement benefit. Here's another one. This one works well if you have somebody that can get preferred ratings. This one is a single premium option with this particular company, but again, you get the $144,000 of death benefit and the $288,000. And you can see on this one, the life portion costs $78,000 and the long-term care costs about $13,000 for $91,000 premium. Now this one has no inflation rider in it. That's what I'm trying to show here, is that there's no inflation on this one. We go to the next slide. We can add in 3% inflation for 20 years. It only adds about $4,000 to the premium. So this one, again, these are some of the combinations if you have somebody that's in relatively good health. Here we have the same thing, but we're insuring both of them. And again, we have a 3% inflation option on both the original face amount and the continuation of benefits. And that's how some of these plans do it. You get 2 years of long-term care from the base, but then you get a continuation of benefits to give you the full benefit for it. So, but we're looking at about $150,000 in this situation. Now, one of the things too people need to look at, and when you're visiting with people, we'll talk about it in a little later here, is a lot of people, when you're talking to them, ask them about, do you have an annuity? Do you have a life insurance policy? Because individuals can look at tax advantage ways to plan for long-term care needs. We can repurpose a lot of life insurance policies that have cash value or an annuity and use the 1035 exchange to give them a long-term care benefit. So don't always think of just, hey, we got to write you this additional policy. And they have to think of, okay, now we got to pay for that out of our monthly income. You know, look at other ways of utilizing their existing assets to pay for this. So this is one of the things that we can look at and take advantage of are these 1035 exchanges. Now you have to remember that you have to exchange like product for like product. So if they have a life policy, you have to exchange it for a life policy. If they have an annuity, you have to exchange it to an annuity. Now, there's millions of Americans that have the fixed annuity in their retirement strategy. But what if we add a linked benefit annuity that has some extra long-term care benefits? And we can do this without costing them any additional money. That's one of the things that we need to look at. And that's why the life long-term care plans or the annuity long-term care plans are becoming much more popular, even than the traditional long-term care. Time changes everything. You know, again, we had that life policy that we needed it for, you know, because we wanted to make sure that we could pay off the mortgage, things like that, or plan, you know, to help increase our benefits for retirement. Now we might want to look at, let's repurpose that and use a life long-term care combination plan. Congress did this, passed these, the PPA benefits to encourage more tax advantage incentives to plan for long-term care. Because again, what happens if we don't plan? Who ends up paying the bill? Well, first off, we get to use our own assets, but then it can come down to the state. So we can take a look at that. In 2016, 3 times as many individuals purchased a linked benefit long-term care policy than the traditional one. Now, let's look at annuities. If we look at how some of these plans work, this particular one has a 2-year waiting period before you can utilize the long-term care benefit. The only requirement is you can't be confined in a nursing home or an assisted living facility on the issue date. You have to be confined to collect benefits. You have to be confined in a qualified facility for 90 consecutive days. You must be confined during the payout period. And on this particular one, if you are on taking money out at, let's say, $5,000 a month, after 2 years, it would double that benefit if you needed nursing home care. So you could take out $10,000. After 10 years, it reverts back, or after 5 years, excuse me, it reverts back to only paying out the $5,000. Again, this is a simple one. Basically, you'll get one health question. Are you confined in a facility at the time you buy it? Here's another one that's based on ADL-based payouts. As long as the annuitant on this one they look at the activities of daily living after the second contract year. This one, the benefits If in year 3, it would pay out 110%. In year 4, it goes up to 115. In year 6 plus, it's up to 25% more. And again, this is just instead of having it in annuity A that doesn't have any long-term care benefits, we can get an automatic increasing benefit if we need it for long-term care. So that's one of the options out there. Here's another one where it automatically in the first 5 years, you get a 25% boost. You don't need it until year 6 through 10, you get 150% boost. Over 11 years, you get a 175% boost. Again, a different product, excellent plan. Again, if they don't need care right now today, all we're doing is giving them that linked benefit versus what they normally had already, and we can do it all with that 1035
Are you still there, Vern?
exchange. Again, this one just looks at where we can include a higher amount, 300,000. If we put in 300,000, it lets us take it out over a little longer period. Again, similar thing with this. Now, here's one of the things that we look at. If we have somebody that's got, okay, $500,000 of assets, they already have the fixed annuity. If we move them into one that has additional long-term care benefits, depending on which plan we're looking at, we can increase that to 150,000 of additional long-term care benefits, or maybe even 300,000. So when we look at if they needed cost of care in here of 580,000, in the one situation, they're only going to end up with 70,000 in assets. The other one, they could have 200,000 that they're passing on to the family. The other one up to 300. So, you know, again, if we can just position this annuity so that it gives them some long-term care benefits, look at how we can benefit the client and their heirs. Now, let's talk a little bit about the short-term care. With traditional long-term care, again, we have 2 years up to an unlimited benefit, inflation benefits. The short-term care plans, again, would be a 2-year max, limited benefit period to help soften the blow to the carrier. Since the limited benefit, we can cut down on the catastrophic claims. We can throw a wider net for underwriting. Shorter apps, very fast issuing. And they can be very flexible and affordable and much simpler, and we don't need any special continuing education to sell them. So let's take a look at these a little bit. Each company is going to ask the questions a little differently. We recommend that you work with a short-term care specialist, and here at Golden Care and Greenhaven, we can help you with that. Some of these particular plans, Golden Care is actually developed, so we have the knowledge and stuff to help you with these. Here's some of the questions that they look at that are on these applications. Do you need help in the past 24 months with walking, eating, toileting, house cleaning, things like that? Need assistance with a walker, chair, cane? Have you been treated for a heart attack or stroke? Had more than one stroke? Have you been confined in a nursing home? Internal cancer, metastatic cancer, kidney dialysis, insulin dependent, Parkinson's, all of those things. They do have height and weight requirements. But here's one of the plans. This one gives you a choice of a daily benefit from $50 a day to $400. We can have an elimination period of 0, 20, 60, or 90. But our benefit period, we can choose 90 days, 180, 270, or 360. And again, the trigger on these is assistance with 2 or more activities of daily living. So very flexible in qualifying for benefits. For home health care on this particular plan, we can take up to $300 a day. And again, we can go up to 360 days. One thing I point out on these is this is 2 separate pools of money, one for the nursing home and one for home health care. This one has 5% simple inflation that you can add. It also has a hospital indemnity benefit that can be added for very little cost. So if we take an example here of the hospital indemnity, if we take a daily benefit of $200 a day for 20 days, a lifetime period is going to be 180 days. We can see the cost for that is only $20 for the male, $17 for the female. These can include things like a prescription benefit. Pays $10 for each generic. And so even with this drug benefit, basically you can, if they're on Medicare already and have a prescription drug plan, the benefit that they receive back on this can almost pay for the premium on these plans. And the other thing that's important on these is there's a restoration of benefits. Again, if they have, after a period of 180 days where they don't need care, it reinstates the full benefit. So think of this, they could have, instead of having just a 1-year plan, they could have almost 2 years of care. And again, it's care for the nursing home is separate from the care for the home health care. And the nursing home is nursing home assisted living. Now, these are on a graded benefit. This is why this one can include a lot more people to get issued, because if we take a $200 a day benefit as what's elected, in the first year, it's only going to pay $100 a day. The next year it goes to $125, and so that in year 5, it's up to the $200 a day. If we take the 5% simple inflation, it doesn't start until year 5 and goes for till year 25 when the benefit has doubled. So again, this is kind of like graded life plans where we can get more people issued. But this plan allows us to get these benefits issued to more people. Now, here's an example of looking at $250 a day for the facility, a 60-day elimination period. On this one, you can go 180 days for the, so 6 months, and we're only looking at $80 and for the husband and $58 for the spouse. If we added $200 a day for home health care, we're only looking at, and this is with 5% simple inflation, we're looking at $30 and another $21. Hospital indemnity adds a little to it, but we're looking at a total monthly premium for the 2 of them of $229. And this is age 66 and 61. So a couple of the things to keep in mind on these is there is a lot of things that would not trigger long-term care claims would trigger short-term care claims. An example would be a knee replacement. Because again, remember on a traditional long-term care policy, they need where it's expected to last 90 days or longer. So a lot of these things, this is where the short-term care policies can let you have your cake and eat it too. And that restoration of benefits is a huge thing too that can be included in these short-term care policies. Here's another example, because these are, again, are a cash payment, an indemnity plan. So if you'd had a $400 a day benefit, which would give you $12,000 a month, in 1 year you could receive $144,000 and no 90-day certification required. If you had a traditional long-term care policy, it would take 3 years to pay out that $144,000. So which one makes more sense? Again, now let's look at some, here's another plan that uses different triggers, not the activities of daily living, but it looks at, you know, have you had a heart attack? Have you had a stroke? Those are the things that can be covered, but those are, once you have those, that's what triggers the benefits on these with this particular plan. So this is one that we can get issued to a lot of people that might not qualify for a traditional long-term care plan because they're looking at different triggers. Again, heart, some of the chronic illnesses. For those, we also have available plans, well, that are not even insurance. They are where you are pre-buying care benefits for home health care. And again, this is not an insurance plan. You are pre-purchasing lifetime hours of care that you can use later on. So we have a wide range of benefits out there that can be used. So on this one, just to give you an idea of the cost, if we're looking at, and age isn't a big factor on these, you're buying, what you're looking at is how much lifetime hours are you buying?
We did actually have a couple.
Okay.
Somebody had asked if the presentation was being recorded and whether copies would be available later. Yes, in fact, we will be sending follow-up emails. We'll have a link to access the recording when that's available. We'll send it along with copies of these presentation slides. But it's pretty typical. We tend to record all of ours. So yes, be on the lookout for the follow-up emails. And another question is, do you ever have cases where a traditional LTCI plan is purchased along with an STCI plan to maximize benefits at a lower total outlay?
Oh, that's a very good one. Yes. What we're seeing, and I was visiting with an agent yesterday, and we were discussing the exact that scenario is, you know, it might make sense to buy. In his situation, he was looking at like a 55-year-old couple, and we looked at, and I showed him the cost of taking a universal life policy that had the long-term care benefits built in. We also looked at the traditional long-term care. But then I also showed him, you know, if you looked at these people, because we have companies that have, even on the term insurance, have that chronic illness rider built in, and the product is convertible through the whole 30 years. If they took a 30-year, you know, whatever the term is, that is convertible to a permanent policy. And we were looking at, you know, it was going to be about $5,000 a year for the traditional long-term care. But we could look at the term insurance, and we were looking at, if I remember right, $500,000 of term or what. And at their age, it was only going to be about $100 a month. So very affordable. And then we could look at, like I told him, we could look at maybe we don't buy a full-blown, long-term care policy. We buy, maybe a plan that pays $4,000 a month, but has an inflation rider. So yeah, that's something that we look at a lot. But again, one of the other things I want to stress is when you're talking to your clients, ask them about what assets do they have? Because again, if they go into the nursing home, they're going to fill out an asset sheet because the nursing home is going to want to know how they're going to get paid. So, find out, do you have an existing life insurance? Is it term? Is it whole life? Is it UL product? Does it have cash value? Can you repurpose that one to a plan that has a long-term care rider added to it or a long-term care benefit? Do they have an old annuity? Maybe we can add, do a 1035 exchange because most of those probably are going to be on their surrender charge period. So look at that because if they're going to a financial planner, the financial planner is going to be looking at how do we pay this out of your assets, not out of your monthly income. And I always use the example, would you rather have your assets earn 5% instead of 6%, but have them protected from long-term care? So look at it, and that makes it a lot easier for them if you're not spending their money that they might use to go on a vacation to Hawaii. Any other questions?
I haven't seen any more come in aside from those two. So everything went very, very well. And your answer to that last question was just the same as ours. We've even done training, previous webinars where we go over some of those different scenarios where the short-term care can be a great supplement to other plans as well. So Vern, I want to thank you so much for your time and for the presentation. You go through things in such a wonderful way, a way of explaining things, and it's always nice to hear a fresh voice. Again, the information that you have from your class, this is all invaluable. And again, we'll be sharing slides with the attendees either later today or tomorrow, so be on the lookout for that. But thank you, everyone, for taking time out of your day and joining us. And a special thank you to Vern again for presenting these various insurance solutions for extended care.
Golden Care is looking forward to serving you with new tools, new products, new innovations, and always the best support in the business to help you succeed in 2022. So give us a call at 800-842-7799 or check out our website at www.goldencareagent.com.